There's a man who doesn't appear on the major financial news networks very often. He doesn't have a blue check mark. He doesn't manage billions for a hedge fund with a glossy Manhattan office. What he does have is a track record that, frankly, is starting to make a lot of very serious people uncomfortable. A few years back, when nearly every major Wall Street bank was telling clients to stay the course, buy tech, ignore inflation, trust the Fed, this analyst made a bold, public, and very specific call. He said commodities were entering a generational bull market. He said the era of cheap raw materials was over. He said the world was about to rediscover what real money looked like. Most people laughed. The financial media largely ignored him. But the people who listened, the ones who actually positioned themselves accordingly, they aren't laughing now. Gold has gone on one of its most extraordinary runs in modern financial history. Silver has exploded higher. Energy, agriculture, base metals, all of it has roared back to life in ways that confounded the consensus. The commodity supercycle he talked about isn't a theory anymore. You're living inside it. So when this analyst speaks again, when he says, here's where I'm putting everything right now, it probably warrants paying attention. And that's exactly what we're going to do today. Because his next call is even bigger than the last one, more specific, more time sensitive. And if he's right again, the window to act is not years away. It is now. Let me tell you what he's saying, why he's saying it, and more importantly, why the data behind his conviction is something you really need to understand for yourself, regardless of whether you ever heard his name before today. To appreciate where we're going, you first have to understand where we've been. Cast your mind back to the economic landscape that preceded the commodity surge. Interest rates had been held at historic lows for well over a decade. The Federal Reserve had expanded its balance sheet to levels that would have seemed science fiction to any economist trained before the year 2000. Capital poured into technology stocks, into cryptocurrencies, into anything with a growth narrative and a slide deck. Hard assets, the stuff you can hold, the stuff that comes out of the ground, the stuff that industrial civilization literally cannot function without, were treated like relics. Oil majors were being pressured to wind down. Mining companies couldn't raise capital. The message from the investment establishment was clear. The physical world is irrelevant. The digital world is all that matters. Our analyst, let's call him the predictor, because that's what the financial underground started calling him, looked at this picture and saw something everyone else was missing. He saw the same disconnect that surfaces in markets every generation or so. When financial assets become completely detached from the physical world that underlies all real wealth creation, the correction doesn't come gradually. It comes violently, and it tends to come in the one asset class everyone abandoned. He pointed to something called the commodity to equity ratio. This is essentially a measure of how expensive financial assets are relative to real, tangible assets. When this ratio reaches extreme lows, when stocks are priced to perfection and commodities are priced for oblivion, history shows you are sitting at one of the most powerful inflection points available to any investor. He showed charts going back to the 1970s. He laid out the 1999 peak in equities and the simultaneous trough in commodities that preceded a decade-long commodity bull run. He pointed to structural underinvestment in mining and energy that had been building for years, and he made his call. He was right. Now he's making another one, and this time his focus has narrowed considerably. He's not talking broadly about commodities anymore. He's talking about one specific metal, the metal he calls the most mispriced asset on the planet right now. He's talking about silver. Before you dismiss that, before your brain files it away in the same cabinet as infomercials and late-night investing pitches, I want you to sit with the following facts for a moment. Because what's happening in the silver market right now is not a story being told by people trying to sell you something. It's a story being told by refinery output data, by industrial procurement reports, by central bank reserve figures, by the documented behavior of the wealthiest institutional actors in the global financial system. Silver is currently trading in a range that, on the surface, might look like it's already had its run. Gold has done extraordinary things. Silver has moved meaningfully higher. The casual observer might think the train has already left the station. The predictor says you're looking at this completely wrong, and the reason comes down to something called the gold to silver ratio. Right now, for every single ounce of gold, you can buy roughly 60 ounces of silver. Think about what that means. Historically, and I mean across centuries of market data, this ratio has averaged somewhere closer to 15 or 20 to 1. In the ground, geologically, silver is only about 8 times rarer than gold, 8 to 1. Yet the market is currently pricing silver at 60 times below gold. That gap is not sustainable. It never has been. Every time in modern history this ratio has blown out to extreme levels, silver has experienced a mean reversion that produced some of the most explosive price appreciation of any asset class in any era. In 1980, when the Hunt brothers cornered the silver market, and I want to tell you this story properly because it tells you something profound about how silver moves. Silver went from under $6 an ounce to nearly $50 an ounce in a matter of months. The Hunt family had come to believe, through careful study of monetary history, that the United States' decision to abandon the gold standard in 1971 was going to trigger a catastrophic debasement of the dollar. They weren't entirely wrong about the thesis, even if their method of acting on it eventually crossed into market manipulation. The price explosion they triggered showed the world something critical. Silver, when it moves, moves fast. The industrial users who need it for manufacturing, the investors who suddenly want it for protection, the speculators who sense momentum, they all arrive at the same door at the same time. And there's simply not enough silver to go around. That dynamic, too many buyers, not enough physical metal, is exactly what the predictor says is building right now. Except this time, the demand drivers are far more diverse, far more structural, and far more impossible to turn off. Let me walk you through the demand side of this equation. For most of human history, silver's primary uses were currency and jewelry. Those uses still exist, but over the past 2 decades, silver has quietly become one of the most indispensable industrial metals on Earth. And the industries consuming it are not declining industries. They are the industries that every government on the planet is actively subsidizing and accelerating. Start with solar energy. Every solar panel manufactured anywhere in the world requires silver. It's a conductive paste that coats the photovoltaic cells. There is currently no economically viable substitute, and the world is building solar panels at a pace that would have seemed fantastical a decade ago. The installed solar capacity being brought online globally each year now consumes a staggering portion of annual silver mine output, and we are nowhere near peak solar buildout. The targets set by major economies, the United States, China, the European Union, India, require solar installations over the next decade that would consume silver at rates the mining industry is structurally incapable of meeting. Then add electric vehicles. Every EV contains significantly more silver than a conventional internal combustion engine vehicle. Contact points, circuit boards, battery management systems, silver is threaded throughout modern electrification. The same EV transition that every carmaker on Earth is scrambling to fund and execute is a structural silver demand driver that compounds annually. Then add artificial intelligence infrastructure. This is the piece that the predictor says even most metals analysts are underestimating. Data centers consume extraordinary amounts of power. The cooling systems, the electrical infrastructure, the semiconductor manufacturing processes, all of it has silver fingerprints. As the AI build-out continues to accelerate, as nations race to build sovereign AI capacity, as every major corporation on Earth expands its data infrastructure, silver demand from this sector alone is growing at a rate that would have been unimaginable when anyone was last modeling the silver supply-demand balance. Now, here is the painful part of the story. While demand has been structurally exploding, supply has been going nowhere. New silver mine discoveries are rare. The easy deposits were found and exploited generations ago. The industry underinvested in exploration for over a decade when prices were low. The mines that do exist produce silver primarily as a byproduct of lead, zinc, and copper mining, meaning silver production is largely determined by base metal economics, not silver economics. When someone decides to build a dedicated silver mine today, assuming they can get the capital, the permits, the skilled labor, and the equipment, they are looking at 7 to 10 years before the first ounce comes out of the ground. There is a structural deficit forming in silver. This is not a fringe theory. The Silver Institute, which is about as establishment as the silver industry gets, has published research documenting supply-demand deficits that have persisted for several consecutive years. The world is consuming more silver than it mines. The gap is being filled by above-ground stockpiles. Those stockpiles are not infinite, and the deficit is, if anything, accelerating. The predictor's next big bet is essentially this: the collision between exploding industrial demand and structurally constrained supply is going to produce a silver price move that will be one of the defining investment stories of this era. And when it happens, it will happen faster than most people think possible. Because silver is a small market. The entire global silver market, all of it, is smaller than many individual technology stocks. It takes relatively little capital from the institutional world to create enormous price dislocations. Before I go any further, and I want to make sure I mention this now, if you're someone who's been paying attention to what I'm describing, if you're thinking about how to actually protect your savings in a way that takes advantage of what's happening in precious metals, I put together a free guide in the description below. It covers the saving strategies that thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free. Check the description and grab it. Now, let me tell you why the monetary argument for silver might actually be even more compelling than the industrial argument. We are living through one of the most significant shifts in the global monetary system since the Bretton Woods Agreement collapsed in 1971. And understanding that shift is essential to understanding why the predictor's next big bet is positioned where it is. For decades, the United States dollar served as the world's reserve currency. Nations held dollars in their central banks, not because they had faith in the United States government specifically, but because the dollar was the agreed-upon medium of global trade. You needed dollars to buy oil. You needed dollars to settle international transactions. This arrangement gave the United States extraordinary economic privileges, the ability to run deficits that no other nation could sustain, the ability to export inflation to the rest of the world, the ability to weaponize the financial system against geopolitical adversaries through sanctions. That last part is critical, because every time the United States deployed the dollar as a weapon, every time it froze assets, every time it cut a nation off from the SWIFT system, every time it used financial infrastructure as a tool of coercion, it sent a message to every other nation on Earth. Holding dollar reserves is a liability, not just an asset. Your reserves can be confiscated. Your access to the financial system can be switched off. The dollar is not neutral. It is a weapon pointed at you. The response from the non-Western world has been a slow, deliberate, accelerating accumulation of alternative reserve assets. And the alternative they keep reaching for, over and over, is gold. Not digital gold, not gold ETFs, physical gold, stored within national borders, held in vaults that no foreign government can reach. Central bank gold buying has been at or near record levels for several consecutive years. The nations leading this accumulation, China, Russia, India, Turkey, Poland, the Gulf states, are not accumulating gold because they think it's a nice collectible. They are accumulating gold because they are hedging against a world where the dollar's reserve status is degraded. They are building the monetary architecture of a post-dollar world, and they are doing it with physical precious metals. Here is where silver enters the monetary story. Silver has served as money for longer than gold has. In many civilizations throughout human history, silver was actually the more commonly used monetary metal, precisely because it was more practical for everyday transactions. The Spanish word for money, plata, literally means silver. The British monetary system was built on the silver pound. The Indian rupee derives from a Sanskrit word for silver. Silver's monetary heritage runs as deep as human civilization itself. As the de-dollarization movement accelerates, as nations look for assets that sit outside the Western financial system, as the understanding spreads that the fiat currency experiment of the past 50 years has produced nothing but compounding debt and recurring crises, the conversation about monetary metals does not stop at gold. It expands to include silver. And that conversation is happening in places and at levels of government that most ordinary investors never hear about. The predictor has been tracking the flow of physical silver out of Western depositories. He has been watching the decline of COMEX-registered silver inventories. That's the metal that's actually available for delivery against futures contracts. He has been documenting the growing divergence between the paper silver market, where prices are set through enormous volumes of futures contracts that will never result in physical delivery, and the physical silver market, where premiums have been quietly but steadily rising. He sees in this divergence the same precursor signal that has appeared before every major silver repricing in history. The paper market sets the price. The physical market tells you the truth. And the truth the physical market is telling right now is that there is far less silver available at current prices than the futures market implies. Let me paint you a picture of what happens when this dynamic resolves. Imagine you are a large industrial manufacturer. You need silver, not theoretically, not 6 months from now. You need it for your production line that runs this week. You contact your usual suppliers. They tell you lead times have extended. They tell you premiums above spot have risen. They tell you they're having trouble sourcing the specific forms you need in the quantities you need. You start calling other suppliers. Same story. You reach out directly to refiners. They have commitments elsewhere. Slowly, the reality sets in. The price you see on your screen is not the price at which you can actually acquire the silver you need. This is called a delivery squeeze. And in the silver market, when industrial demand meets monetary demand simultaneously, when the factories and the investors and the central banks and the speculators all arrive at the market at the same time, the price adjustments can be violent and rapid. The Hunt brothers, operating with far less capital than today's institutional players and motivated by a single thesis, moved the silver price by roughly 800% in a compressed timeframe. They were eventually stopped by a regulatory intervention that changed the rules mid-game. Today's demand drivers are not a family. They are not one actor. They are thousands of industrial procurement departments, hundreds of investment funds, dozens of central banks, and millions of individual investors. There is no single entity to stop. This is why the predictor's next big bet focuses specifically on the silver opportunity, with a conviction he says exceeds even his commodity supercycle call from years ago. He frames it simply. You have an asset that is simultaneously the most critical industrial metal of the green and digital economy, a monetary safe haven with 5,000 years of history, structurally undersupplied relative to growing demand, and priced at a fraction of what the gold to silver ratio alone suggests it should be worth. The stars don't align like this often. He says when they do, the right move is obvious. Now, I want to address something that I think holds a lot of people back when they hear this kind of analysis. They think, I've heard this before. I've heard the gold story, the silver story, the inflation story. They've been telling me the dollar is going to collapse for 30 years, and I'm still buying groceries with dollars. Why is this time different? It's a fair challenge, and I want to give you a serious answer. The reason most predictions of monetary collapse or currency debasement have seemed premature is not that the underlying thesis was wrong. It's that the timing of these events is genuinely difficult to predict, and they tend to move in very long, slow cycles before they suddenly accelerate. The Roman Empire debased its currency over centuries before the collapse came. The Weimar Republic's inflation built slowly before it became hyperinflation virtually overnight. The key insight is not that the dollar is going to zero next Tuesday. The key insight is that we are deep into a process of monetary debasement that has been underway for decades, that the pace is accelerating, and that the assets which have historically preserved wealth through these processes are the same assets the predictor is pointing at right now. The question is not whether you believe in catastrophic collapse. The question is whether you believe in the erosion of purchasing power over time. And if you've been to a grocery store, filled up your gas tank, paid your utility bill, or tried to keep your retirement savings growing faster than the cost of living, you already know the answer to that question from direct personal experience. The predictor talks about what he calls the quiet crisis, the slow, grinding loss of purchasing power that doesn't make headlines because it doesn't happen in a single dramatic event. It happens one grocery bill at a time, one insurance premium at a time, one medical expense at a time. Retirees on fixed incomes feel it most acutely because they can't simply earn more money to offset the rising cost of everything. They are living on assets they spent decades accumulating, and those assets are being quietly, relentlessly devalued by monetary policy decisions made by people who will never face the consequences of those decisions personally. This is exactly why I want to take a moment here for anyone watching who is approaching retirement or already in retirement and who has worked hard to build a meaningful nest egg. The strategies that protected your parents' and grandparents' wealth, keeping savings in the bank, holding bonds, relying on the traditional portfolio, were designed for a monetary environment that no longer exists. Interest rates that once compensated savers for holding cash have been deliberately suppressed for years. Bond yields that once provided reliable income barely keep pace with real-world inflation. The financial system has been restructured in ways that systematically transfer wealth from savers to debtors, and the biggest debtor of all is the United States government. The people who understand this, and I mean the genuinely sophisticated wealth managers, the family offices, the people who manage money for the ultra-wealthy, have been quietly repositioning into hard assets, precious metals, and specifically into vehicles that give them direct physical exposure to gold and silver within their retirement accounts. Not paper exposure, not an ETF that holds a promise. Physical metal, allocated in their names, stored in insured vaults outside the traditional banking system. If that kind of wealth protection strategy is something relevant to your situation, if you have retirement savings that you want to shield from the dynamics we've been discussing, I've put together a resource in the description below that explains exactly how this works, how to get physical gold into a retirement account without triggering taxes or penalties. It's worth understanding even if you ultimately decide it's not for you. Back to the predictor and his next big bet, because there's a layer to this analysis we haven't touched yet, and it may be the most important one. The predictor has been studying what he calls the institutional migration in precious metals. This is the shift from large professional investors treating gold and silver as portfolio insurance, a small allocation, a hedge, an afterthought, to treating them as core positions, primary holdings, and in some cases, the central thesis of entire funds. This migration is still in its early stages. The total amount of institutional capital that is repositioned into precious metals, even after the extraordinary runs of recent years, remains a small fraction of the total institutional investment universe. Global bond markets alone dwarf the entire precious metals market by a factor that would genuinely shock most people. When even a modest reallocation of institutional capital seeks exposure to gold and silver, the price effects are enormous. Not because the institutional world is wild and speculative, but because the target market is so small. The predictor uses an analogy that I think captures this perfectly. Imagine a group of elephants deciding they want to move through a room full of mice. The elephants aren't trying to cause chaos, they're just trying to get comfortable. But in a small enough room, even the most careful elephants create enormous disruption simply by moving. The elephants, the pension funds, the sovereign wealth funds, the endowments, the family offices, the insurance companies are starting to move. They are starting to look at gold approaching record territory and asking whether silver, still priced at a fraction of its historical relationship to gold, represents a more compelling entry point. They are starting to build positions, quietly, methodically. And the room, the silver market, is very, very small. Let me also pull back and look at the broader geopolitical architecture, because the predictor says you cannot understand the metals market in 2026 without understanding what is happening to the global trade and monetary order. The period of globalization that defined the economic world for several decades is fracturing. Supply chains are being regionalized. Trade relationships are being restructured around political blocs rather than pure economic efficiency. The weaponization of financial infrastructure, sanctions, dollar cutoffs, asset freezes, has accelerated a race among non-Western nations to build systems that do not depend on Western financial intermediaries. The BRICS nations are actively developing alternative payment systems, alternative reserve frameworks, and alternative financial architectures that explicitly envision a reduced role for the dollar. None of this happens overnight. None of this represents a clean, sudden transition. But it represents a directional shift that has been building for years and is continuing to accelerate. And at the center of every credible alternative monetary architecture being discussed in these forums is gold, physical gold, held by sovereign entities outside the Western system. The predictor's observation is that gold at current price levels has already begun discounting some of this shift. The extraordinary price appreciation we've seen reflects, in part, the market beginning to price in the reduced dominance of the dollar-based system. But silver, he argues, has barely begun to price in these same dynamics. And as the de-dollarization story moves from theoretical discussion to practical implementation, as alternative payment systems get built, as trade settlement moves away from the dollar, as nations reallocate reserve portfolios, silver's role as both monetary and industrial metal positions it uniquely. There is a concept in markets called the last free market. It refers to an asset class that has not yet been discovered and bid up by the mainstream, one where the fundamental value is clear and compelling, but where the crowd has not yet arrived. The predictor has been pointing at silver as exactly this, a market where the industrial users see the value clearly, where the historically minded monetary scholars see the value clearly, where the de-dollarization analysts see the value clearly, but where the mainstream retail investor and the large institutional allocator have not yet fully arrived. When they do arrive, when the silver story becomes the consensus trade rather than the contrarian one, the price action will likely feel disorienting to people who weren't positioned. It always does. The people who held silver going into the 1980 move, the people who were buying gold in 2001 when everyone else was chasing internet stocks, the people who understood the inflation thesis in 2020 before the commodity rally materialized, they all lived through the same experience. They watched everyone around them ignore what they saw. They held their positions through periods of doubt, and then they watched the crowd arrive all at once. That's the bet. That's what the predictor is saying the data is pointing toward. A move in silver that will likely feel sudden to most observers, but that has been building, structurally and quietly, for years. Now, one more dimension to this story that I want you to really absorb before we close out today. There's a concept called monetary velocity that describes how quickly money moves through an economy. When monetary velocity is low, when people are hoarding cash, sitting on savings, delaying spending, inflationary pressures can be contained even when the money supply is enormous. This is the dynamic that kept inflation relatively subdued for years after the post-2008 monetary expansion. The money existed, it just wasn't moving fast. But when confidence in currency shifts, when enough people and institutions begin to question whether holding cash is a good idea, when the inflation psychology becomes self-reinforcing, monetary velocity increases. And when it does, the inflationary dynamics that were latent become manifest. They appear suddenly, they appear everywhere, and they are very difficult to reverse without causing severe economic damage. The predictor argues that we are in the early phases of exactly this transition. The consumer, battered by years of real purchasing power erosion, is beginning to shift behavior. The institutional world, watching central banks continue to expand balance sheets, is beginning to price in a structurally higher inflation environment. The smart money is moving away from cash and toward assets that have historically maintained purchasing power through monetary disorder. Gold is already reflecting this. Silver is next. And here is the thing that keeps the predictor up at night, in the best possible sense. The thing that makes him more convicted on this trade than almost anything he has analyzed in his career. Silver is the one asset where the industrial demand story and the monetary demand story are pointing in exactly the same direction, at exactly the same time. You don't need to believe in one thesis. You get both simultaneously. The factories need it for solar panels. The investors need it for portfolio protection. The central banks want it for reserve diversification. The individuals want it for wealth preservation. All of those demand streams are flowing toward the same small market at the same time. That is not a normal market setup. That is what the predictor calls a convergent catalyst, a rare configuration where multiple independent demand forces align around a single target. In his analysis of markets going back decades, he says these configurations produce the most dramatic, most persistent, and most rewarding moves available to investors who are positioned correctly before the convergence fully manifests. Where does he see the silver market going? He doesn't like to put a number on it because he thinks price targets create the wrong psychology. They cause investors to sell when a target is hit, rather than holding through what could be a much larger move. But when pressed, he talks about the gold to silver ratio. He talks about where that ratio has historically normalized. And when you do the arithmetic using current gold prices, the numbers are significant enough that most people's initial instinct is to dismiss them. The predictor says that's always how it works at the beginning. The numbers that turn out to be correct always seem outrageous until they happen. Then everyone says they saw it coming. The question you have to ask yourself is not whether the predictor is going to be right. You can't know that with certainty, and anyone who tells you otherwise is selling something. The question is, given what the data actually shows, the supply deficits, the industrial demand growth, the monetary dynamics, the institutional migration, the geopolitical realignment, what is the asymmetry of the opportunity? What is the cost of being early? What is the cost of being wrong? And how does that compare to the cost of being right but not positioned? The predictor made his commodity call years ago. Most people weren't positioned. Most people watched it happen from the outside. Some acted on it. Those people are having very different financial conversations today.